Happy Friday, everybody. We hope you're having a good week. There's been some interesting developments. I don't know if everybody's been following this back and forth with the Federal Reserve, but the Federal Reserve did cut interest rates this week. Now, they cut it just by a quarter of a percentage point, and we're at a very interesting and very challenging point for the Federal Reserve because there is a slowdown, and there has been a consistent slowdown in the labor market really over about the last 12 months. And normally, what the Fed would do is they would cut rates, right? Cutting rates means that it's easier for businesses to make investments, to get loans. Loans are cheaper, there's less debt to pay back. And that means there's more cash to do things like invest in people, invest in technology, invest in growing the business. The problem that we're running into is that inflation still is not under control, right? By some measures, particularly the core measures, right? If you strip away some of the volatile things like food and energy, we're at about 3%, right? Inflation is still at about 3%, which is well above where the Fed would like it, which is 2%. And so if they cut interest rates too much or too fast, it could re-spark inflation. Now, remember back in 2022, right? Inflation was running at 8, 9, 10%. One of the big reasons that we had a change in administration was because of that inflation. Now, if that inflation comes back, the Fed's tool is to raise interest rates. Well, the problem with raising interest rates is it chokes off business investment and it hurts the labor market. So this is where the Fed is in a little bit of a bind because you've got a labor market that's softening that would require a reduction in rates. You have inflation, which is not going down, which requires a raising of rates to get that under control. And so these two forces are pushing and pulling and tugging against each other. And the funny thing is, it doesn't seem yet to have had much of an effect on the market, right? The stock market seems to be happy, right? Rates were cut. Stock market loves when rates are cut because they think that there's going to be more investment. Stock prices are going to go up. This could be in for a big challenge, right? And I think one of the more interesting phrases that I've heard lately is Larry Summers, who was and has been an economist in a couple presidential administrations, was also the president of Harvard, said that the economic administration by the current administration, right? The way that the administration is managing the economy is kind of like driving drunk, right? You can do it and get away with it, but eventually it's going to catch up with you. And I think that that's a really good way to think about risk management and how we're dealing with portfolios right now. Just because the stock market's going up doesn't mean that we're just piling in and being really excited about it. We're still having dividends, interest, pay to cash. We are building up those cash reserves so that when we get opportunities, when the market dips, or when the economy starts to crack and we do get pullbacks, we have cash to invest. We're not selling into a downward market. And so that combined with making sure we're holding high quality stocks and high quality bonds to reduce volatility in your portfolio is a way that we're dealing with some of this uncertainty and then back to some of these push and pull tug of war here that's going on with interest rates. So unless your goals have materially changed, we are going to continue to ride this wave, knowing that eventually it's going to break. And because of that, we are having cash, right? We're building up cash through payouts, and we're making sure that we're owning high quality assets as opposed to speculative assets, because even though there might be a reduction in short-term return, we're investors and we care about what we're going to get on the long term. If you have any questions, please feel free to email or call us and have a great weekend.